Welcome to this explainer. We're going to dive straight into the data today to discover exactly why a looming geopolitical crisis somehow collided with a record-high stock market. I am absolutely thrilled you're here because today we're tearing down the mainstream narratives, we're tuning out the noise, and we're looking at the cold, hard numbers that actually dictate how our modern financial system operates.
So, today we're playing detective to uncover the mechanical gears really driving the market. And we're starting with a glaring paradox from this past April. Why on earth do stocks hit record highs right when war breaks out? On the surface, it literally defies all basic logic, right? But to really understand this, we have to look at what Wall Street was up to right before this event.
Let's rewind the timeline a bit, back to late February and early March. We saw escalating tensions in the Middle East. Specifically, the US and Israel launching joint airstrikes on Iran, and then Iran shutting down the Strait of Hormuz. This caused a massive, measurable market reaction. By late March, the S&P had dropped 9%. That capped off its worst 5-week losing streak in almost 4 years. And while everyday retirement accounts were quietly taking a beating, something way more dramatic was happening behind the scenes.
Under the hood, Wall Street was in absolute panic mode. Hard data straight from Goldman Sachs' prime brokerage desk gives us a peek at what hedge funds were actually doing behind closed doors. And guess what? Their data shows that Q1 hedge fund selling in North America was the highest it's been since April 2020. These funds were heavily leveraged. We're talking gross leverage sitting near an all-time high of over 300%. And their short exposure to macro ETFs, like SPY and QQQ, hit pandemic-era highs. Basically, they were betting massive amounts of money that the market was going to crash.
And honestly, it wasn't just the hedge funds. Oil and commodity experts were genuinely terrified. Take commodity analyst Rory Johnston. He pointed out that with the strait closed, we'd still need to shed 15 million barrels a day of global demand. He was warning of a shockwave way too large for the system to handle, predicting oil could hit $250 to $300 a barrel. And he wasn't using a mild word like recession. He explicitly called this scenario depressionary. So the sentiment on the street? Undeniably, heavily bearish.
Okay, so here is where the paradox really begins. On the evening of April 7th, Donald Trump announced a ceasefire in the Middle East, and the very next morning, the markets just completely exploded upward. The S&P closed up 2.5%, the Nasdaq climbed almost 3%, and the Dow jumped over 300 points. More than 400 names in the S&P finished in the green. It was literally the market's best day in almost a year.
Naturally, traditional financial media immediately started calling this a relief rally, celebrating a return to world peace and resumed shipping. But the hard maritime data completely tears that narrative apart. According to the maritime intelligence firm Windward, who uses AI to cross-reference digital GPS signals and satellite radar, only 5 outbound carriers were actually detected moving through the strait by midday. Let me put that in perspective. That is a 96% decrease in freight activity compared to the pre-war baseline of about 130 daily transits. So there was no actual world peace. The strait was effectively still totally shut down.
Since actual geopolitics clearly weren't driving this massive market move, we have to look at the underlying math. We're going to walk through what I call the 3 mechanical dominoes: the short squeeze, CTA algorithms, and options hedging.
Right, so domino number 1 was a classic short squeeze. Remember those massively over-leveraged hedge funds from the Goldman Sachs data we just talked about? Well, when you short a stock, you borrow shares, sell them, and hope the price drops so you can buy them back cheaper. But if the price goes up instead, you are in serious trouble. A rapid price increase triggers margin calls, which forces those short sellers to buy back those borrowed shares just to cover their bets. And all that forced buying, it pushes the price up even higher, which triggers more margin calls and even more buying. So when the ceasefire announcement caused a slight initial price bump on April 8th, it ignited this exact squeeze.
Domino 2, the algorithms. This is how systematic models amplify market moves.
Once that short squeeze lit the match, the algorithms kicked in. This is the part where human emotion completely leaves the chat, and systematic models take over to massively amplify the market's momentum. Specifically, we're talking about CTAs, or Commodity Trading Advisors. These are systematic trading firms running entirely on strict, rules-based models. They are completely emotionless. They don't read the morning news, they couldn't care less about geopolitics, and they trade mechanically based purely on price trends. If the trend is down, their algorithms say short. If the trend goes up, they say long. Simple as that.
And the scale of their impact is just absolutely staggering. We're talking $86 billion. According to Goldman Sachs, going into the ceasefire, these CTAs were sitting on about a $30 billion net short position. But the second the S&P crossed certain upward trigger levels, which, remember, were caused by our initial short squeeze, these models mechanically flipped. And they didn't just go to neutral, they flipped to go long, buying an incredible $86 billion of equities over just 5 trading sessions. Goldman actually noted this was a top 5 buying speed print of all time.
Finally, Domino 3, options hedging, the forced buyers of the derivative market.
The absolute key concept here is what's called a negative gamma regime. The leading financial data platform Spot Gamma flagged that the market was in this exact state heading into the ceasefire. In simple terms, dealers who sell options have to keep their own risk books balanced, or delta neutral. Now, in a negative gamma regime, when customers suddenly pile into call options, betting the market will go up, dealers are mathematically forced to buy the underlying stock as its price rises. Price goes up, dealers are forced to buy more. Price goes up even more, they have to buy even more. It's an automatic pro-cyclical loop.
So when you stack all these up, you get a massive chain reaction. It's crazy. Massive short positions get squeezed, which forces buying. That upward trend triggers algorithmic CTAs to flip long, forcing more buying. Those exploding prices then force options dealers to hedge their books, forcing yet more buying. Basically, these 3 dominoes stacked on top of each other to create a massive mechanical rally that was entirely 100% detached from the actual realities of geopolitics.
Now, you might be thinking, okay, well, this was just a freak, isolated incident. But it wasn't. The underlying structure of the stock market has fundamentally changed. We saw these exact same mechanisms play out with interest rates back in December 2018 when the Dow exploded over 1,000 points in a single session. And we saw it again with the yen carry trade unwinding in August 2024. Different catalysts, sure, but the exact same mechanical reaction. This proves a massive structural shift in modern finance.
Let's actually do a direct comparison of how things used to be versus how they are now. 20 years ago, the old market was dominated by human portfolio managers. Actual humans drove prices by reading earnings reports, modeling cash flows, and making discretionary valuations based on what companies were, actually worth. Today, that fundamental market is virtually gone. The new market is totally dominated by passive index funds, massive multi-strategy mega funds, algorithmic models, and derivative hedging. To really put the scale of this shift into perspective, a massive 63% of all U.S. stock funds, which is over $13 trillion, is today held as blind money by passive indexers. This money doesn't read earnings reports, it doesn't care if a company had a good quarter, it just buys on autopilot based on market cap weighting. Because it blindly follows the index, the bigger a company gets, the more they automatically buy. This is exactly why the Magnificent 7 tech stocks now make up over 33% of the entire S&P 500. A huge chunk of the market is receiving allocation purely by default, not by active valuation. And what about what's left of the active investing side? Well, that's transformed too. It's basically been consolidated into a handful of multi-strategy megafunds like Millennium, Citadel, and Point72. These funds are operating at 4 to 8 times leverage, and they're governed by strict automatic drawdown rules. When they hit a limit, they don't sit around a conference table and debate the news. They sell immediately, period. Add to that the hyperactive options market. Same-day expiration options now make up around 63% of all S&P trading. That is a staggering $2 trillion of notional value changing hands on peak days. And every single one of those trades forces a dealer to constantly hedge and react in real time. So, the stock market we used to know, that romantic idea of discovering undervalued companies and holding on to them, is just gone. What's left in its place is a giant feedback loop of algorithms, passive funds, and options dealers, all just reacting to each other in real time. Traditional financial media is always going to try and attribute massive market moves to world events. They want to give you a logical, digestible reason. But the truth is, headlines are really just comforting narratives. They're stories used after the fact to rationalize the mechanical math that's actually moving the needle. So I'm going to leave you with this final provocative question to think about. If the market's daily swings are actually driven by blind money, emotionless algorithms, and forced hedging, rather than real-world facts or company fundamentals, how does that fundamentally change your investing strategy moving forward? Thank you so much for joining me for this explainer. I really hope this dive into the data gives you a much clearer, sharper lens through which to view the market tomorrow. Keep learning, and I'll see you next time.